Today, what New Zealand can teach us. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed post covering finance and problem news with a distinctively Australian flavour. Economists, by nature or nurture, are like living and breathing versions of the Picasso paintings that show both sides of a solitary image. So well known is their use of the phrase "on one hand, but on the other hand," that President Harry Truman once famously asked for a one-armed economist to provide him with economic counsel. With that caveat, New Zealand is, I think, a Petrie dish for how tight monetary policy plays out. The Reserve Bank of New Zealand started lifting rates earlier than other central banks last year and are set on more rises ahead. And now, according to a Reuters poll, New Zealand house prices are forecast to fall 10% this year and 5% next, as aggressive interest rate hikes will take some heat out of a blazing housing market, but not enough to solve the ongoing affordability crisis. Billions of dollars in government stimulus and historically low interest rates during the pandemic have inflated house prices far ahead of wage growth in one of the least affordable housing markets in the world. House prices have risen more than 40% since the start of the pandemic and nearly doubled in the last 7 years, which has led to increased homelessness, fueled inequality, and kept many would-be first-time homebuyers as renters. Although house prices fell a modest 1.6% year-to-year in July, it's its first annual fall since 2011, they are still very far from returning to pre-pandemic levels. Average home prices are expected to decline 10% this year, according to the poll from August the 15th to September the 1st. The Reuters survey was of 11 property analysts. Those estimates show a slightly deeper decline than the 9% fall predicted in a May poll. Another 5% fall was also expected next year. House prices will continue to decline, and there is not much in the economic outlook that will stop that, said Sharon Zollner, chief economist at ANZ. With private sector wage growth accelerating to 7% in the year to June 2022, there's a risk that the Reserve Bank of New Zealand may need to lift interest rates even higher than expected, which would weigh further on real house prices. Despite the expected fall, the drop in prices was too small to offer much reprieve for first home buyers. Average prices have soared over 250% since 1998, almost 4 times the average increase across OECD countries. And the Reserve Bank of New Zealand, which has considered house prices in its policy deliberations, has hiked rates by a total of 275 basis points since October last year and is forecast to take rates to at least 4% early next year. Indeed, in a recent Bloomberg interview, Adrian Orr underscored that rates will have to continue to rise with the objective of slowing economic momentum to tackle inflation. It's worth listening to what he said during his visit to the Jackson Hole Love-In last week.
So we've been trying to get back to a position where we can be more data-driven again, rather than the rush back to north of neutral. We know we had to slow the economy. We knew we had to be at 3% or plus to even begin that slowing journey. And so now really we're in a much more comfortable position. We think there'll be at least another couple of rate hikes. But then we hope to get in a position where we can be data-driven and get back to our normal position of watching, worrying and waiting.
Have no doubt, he has serious intent.
We're watching for signs where we can be, 1, confident we are slowing the economy, and 2, confident that that is credible and feeding into inflation expectations.
You're clearly watching all measures of the economy very closely, and the consumer is one of the big drivers of any economy. We saw the retail sales for New Zealand, the yearly rate negative for the second quarter in a row. And we just saw the first quarter of GDP a little bit negative. And so now people are saying, well, retail spending is pretty important. Are we going to see a second negative quarter? The technical recession, do you think that's possible?
I mean, our core view is no, that we won't see a technical recession. There's quite a reasonable bounce back in economic activity for Q2 of this year. We need very low consumption. In fact, our outlook is for almost flat real consumption. And so, for us to see retail sales come off like that, it's not a surprise. It's a good signal that monetary policy is biting, that we're doing our work.
And appears unlikely to take rates lower anytime soon. That's an object lesson for other central banks and for economists and market analysts who are even now still keen on talking up the so-called pivot. And prices must drop around 20% to reach a sustainable level, the central bank says. But some respondents in the poll said that more was likely to be required. Capital Economics, Infometrics, and Kiwibank said average house prices would have to fall between 20 and 30%, roughly the amount they fell after the oil shock of 1973, to make housing affordable. It will take until at least 2027 for house prices to be back towards a more fair valued position. In real terms, said Brad Olson, principal economist at Infometrics. And when asked to describe the level of New Zealand house prices on a scale of 1 to 10, from extremely cheap to extremely expensive, the median response was 8. For Auckland, it was 9. And so while the Reserve Bank of New Zealand does need to take home price movements into consideration when making interest rate calls, it seems to me that the objective of snuffing out inflation is number 1, number 2, and number 3. And to that end, if higher unemployment or lower home prices are a necessary consequence, then so be it. And you can read across from New Zealand, I think, to Australia and to a number of other Western countries too. And I think you can expect home prices to continue to fall, and I think the rate of fall will increase as interest rates continue to rise. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.